Welcome to Organized, the Business Law Breakdown. I'm Professor Seth C. Oranburg, and in this first episode of our new season, we're kicking off a comprehensive series on organizational choices, specifically how to select the right business entity for a new venture. Whether you're a law student grappling with these concepts for exams or bar prep, a startup founder looking to structure your business efficiently, or even a seasoned professional advising clients on entity formation, understanding the full landscape of legal structures available to organizations is absolutely essential. It's the foundation that could make or break a business's success, and it incorporates liability protection, tax implications, governance, and beyond. Now, for law students in particular, I'd strongly recommend you start with my earlier series on the individual types of entities. Those lectures provide the doctrinal depth with black letter case law, case analysis, and statutory breakdowns that we'll reference, but we won't dive into with the same level of granularity here. So if you haven't already, pause this episode and go back to listen to my prior seasons on agency, which sets the foundation, partnerships, which are basic non-hierarchical or flat organizations, corporations, which are your traditional hierarchical form of organizations, and limited liability companies, which are flexible. Those lectures will give you the deep dive into what the law actually says, and will include their key statutes like the Uniform Partnership Act, Delaware General Corporation Law, and the Uniform Limited Liability Company Act. But if you're ready to move beyond the basics and you want to learn how to apply that knowledge in real-world scenarios, how to function within the law and make practical strategic choices, then this is the series for you. Because here we're going to bridge theory and practice by turning abstract rules into actionable business advice. Over the next 6 episodes, we'll systematically walk through the most common entity types in American law: general partnerships, limited partnerships, corporations, and limited liability companies. These aren't just theoretical constructs, they're the building blocks of trillions of dollars in economic activity. We'll evaluate each one using a consistent analytical lens, a structured framework. We'll have 7 key legal issues that arise every single time someone asks the fundamental question. The question being, what kind of business should I form, will be answered using a structured 7-issue matrix. So by the end, we'll have generated what you can think of as a overall 4x7 chart. We have 4 entity types analyzed across 7 critical issues, resulting in 28 points of comparison. So if you follow along for this entire season, you'll be able to fill in those 28 boxes with detailed information. And by creating this yourself, it will teach you how to process, analyze, and ultimately make informed decisions on entity selection. My matrix isn't just a tool, it's a mental model designed to carry theory into practice. It will help you spot risks, spot opportunities, and evaluate trade-offs quickly. So let's outline those 7 headers right now, because they'll form the backbone of all our discussions. Whether you're advising a client on starting a company or restructuring an existing one, these are the 7 core questions I always use to guide my entity selection process. So let's get into it. 1. Formation. Formation is about how the entity is created. What specific filings, documents, or formalities are required? For example, does it involve just a simple handshake? Or do you need to draft articles of incorporation and submit them to the state? Understanding formation helps you assess upfront costs, time, and complexity. And that's crucial for bootstrapped ventures or well-funded enterprises. 2. Liability. Liability asks who's on the hook if the business racks up debt or faces a lawsuit or incurs tort liabilities. The issue is often a top priority for risk-averse founders and for investors in some cases. And it determines whether personal assets, like a founder's home or personal bank account, are protected or exposed. We'll explore concepts like limited versus unlimited liability and when courts might pierce the veil. 3. Control. Who actually manages the day-to-day business? Who makes key decisions? Who's authorized to bind the company in contracts? This ties into governance. Think one person, one vote in partnerships versus one share, one vote in corporations, and even more exotic forms like token-based governance and decentralized autonomous organizations. Getting governance wrong can lead to power struggles or inefficient operations. You want to run the company in a manner that fits the kind of business you're trying to operate. 4. Financial rights. Who gets the profits when things go well? And who absorbs the losses when they don't? So financial rights covers distributions, dividends, and allocations. And we'll talk a bit about how taxes factor in. It's where incentives align or misalign, and mismatches can breed resentment among co-founders. 5. Continuity. Continuity is what happens when an owner leaves or retires or dies. Does the business survive or does it dissolve? This issue highlights stability, which is vital for long-term ventures like family businesses or corporations or any entity seeking perpetual existence. And by the way, not all do. So if we want to have a limited time fund, we want to factor that in here as well. 6. Liquidity. How easily can an owner sell, transfer, or exit their investment? Is it simple, like trading stock on an exchange? Or are there restrictions, which can range from rights of first refusal to the outright inability to sell your ownership or governance rights without unanimous consent of everyone else in the business? Liquidity affects attractiveness to investors and flexibility for owners. And 7, mergers. How straightforward is it to combine with another entity, to acquire a competitor, or to be acquired? This includes process for mergers, conversions, or transformations. And that's key for growth-oriented businesses eyeing scalability or exits. You might start, for example, as an LLC, but convert to a Delaware C corporation at some point in the startup lifecycle. So we might do this through conversion, which we'll categorize as a type of merger. Together, these 7 issues, which again were 1. Formation, 2. Liability, 3. Control, 4. Financial rights, 5. Continuity, 6. Liquidity, and 7. Mergers. These 7 issues form a framework, and we'll apply it rigorously to 4 main entity types, which are going to be the general partnership, the limited partnership, the corporation, and the limited liability company. And this 4x7 matrix, this 28-box matrix, will create a clear apples-to-apples comparison that you can use to provide support for the decision on what entity to form. I want to be clear, however, that this is not exhaustive. There are nuances like fiduciary duties, and there's a whole nother dimension to this matrix that we just won't have time to deal with in this series, and that is jurisdictional choice. In addition to having more actually than these 4 main entity types, I mentioned decentralized autonomous organizations earlier, and there's also other flavors like low profit limited liability companies and benefit corporations and a few other exotic forms. But these 4 give you context for how this decision is made. But it actually would differ based on what state you incorporate in, because some of the rules regarding how the business operates are state law. And you can choose to incorporate in any of the 50 states as well as U.S. territories. And for that matter, you can form a business outside the United States. So we could almost imagine a much more complex matrix where we repeat this 28-cell exercise in at least 50 dimensions, or at least 50 other states in a third dimension. We're not going to do that here. We're just going to begin with the rows and columns I described, because we're going to build the core analytic skill of making fundamental organizational choices. So our columns will be the 7 issues I described, and the rows will be the 4 primary entity types. And just again, to be clear, general partnerships, limited partnerships, corporations, and limited liability companies are not the only options, but we're just not going to get into some of the variants like S corporations, professional corporations, and other emerging forms now, because I want to focus on the foundational tropes. These are organizations I selected because they represent a common type of business, a common structure you might want to form. And so they're really the backbone of this analytical process. When we analyze which entities to select, we'll populate the matrix by considering factors like whether formation is important, whether we care about filings and paperwork, whether liability is a major factor or a minor one, how control is supposed to be distributed, whether we want a democratic relationship or a hierarchical management. Financial rights will address whether equal shares or some more customizable approach is what we're going for. And continuity will discuss the fragility of partnerships versus the durability of corporations. Liquidity will talk about how partnerships have built-in restrictions versus the free transferability in the largest corporations. And mergers will talk about some of the complexity in changes over time and the end of a business life cycle. So this systematic approach will ensure we compare like to like, revealing why one form might suit a tech startup while another fits a family-owned shop. So why does this all matter? Because entity choice profoundly affects real-world outcomes. In the business arena, stakeholders care deeply about who faces lawsuits, who pockets profits, and who holds veto power over deals. You pick the wrong structure, you might drown in taxes, or at least pay more than you have to. You might expose owners to crippling personal liability, or watch a business crumble in deadlock. On the flip side, a wise choice aligns everyone's incentives, mitigates risks, and paves the way for sustainable growth. Think how corporations enable massive scaling through stock markets, or how LLCs offer flexibility for creative profit and loss sharing. So each of the next episodes will zero in on a major entity type. We'll dissect its key characteristics, its strengths, and its weaknesses, always through the prism of our 7 issues. And again, we're going to go entity by entity to build out this matrix. So episode 2 will be about general partnerships, which are the simplest. So we'll start with the most informal structure. But this informality has a cost, and that cost is unlimited liability. This might be great for quick collaborations, but it's dangerous without careful agreement. We'll then talk about limited partnerships, which is a more modern, but still old, evolution, which is focused on investments. LPs, or limited partnerships, are the classic form of investment vehicle, where we have partners who are money and we have partners who are management. So that distinction between these types of partners will be taught through the limited partnership frame. That moves us into corporations, which are the hierarchical powerhouse. They're designed for scalability, and they're widely used for business purposes. There's a cost to them too. They pay more taxes and they have the most formalities. But the fact that they exist means they must have some value. So we'll try to uncover that. And then we'll talk about limited liability companies, because that's a flexible hybrid that you can't really understand without understanding the other forms, because it can basically morph into having partnership-like characteristics, limited partnership-like characteristics, or corporation-like characteristics. So it makes sense to talk about it last. It's actually a go-to for many, but I don't know if they're always formed well. Sometimes you think, I'll pick the most flexible form because then I have choices, but as we'll see, there are costs to flexibility as well. One of those is you need to have a really well-drafted operating agreement, and not everybody does that. So as we gear up for episode 2, take a moment to reflect. What kind of business do you envision building? What are your top priorities? Is the goal simplicity because it's just a side hustle? Maybe it's just a business you operate in your own name and you put it on your Schedule C on your taxes. But if you're an investor who is looking for a high-growth startup, how do you get the kind of protection from your own liability and for your personal assets, as well as the ability to control management through their fiduciary obligations? If you're a lawyer, consider your client's needs. Is your client prioritizing control? Is liability shielding non-negotiable? There's no one-size-fits-all answer, but our framework will empower you to navigate business formation choices methodologically. So one last thing before we close and jump into the substance. While our matrix focuses on 4 core types, remember there is a third dimension which is becoming more important. So I'll briefly talk about jurisdiction. You might have heard about what's called Dexit, DEXIT, which is a shorthand way of saying companies leaving Delaware and reincorporating in other states like Texas, Nevada, and Wyoming. And that's because these other states are offering different choices for corporate law. So it's a living example of how corporate law is not a monolith. Corporate law is state law. And you get different corporate law in Wyoming than you do in Nevada, than in Texas, than in Delaware. So there's an additional dimension to this matrix that we're not going to address, but is absolutely relevant to the decision making in the real world. The short version is that the classic choice is for a small business to incorporate in whatever state they're operating in, and for a scalable business to incorporate in Delaware because they have very clear and well-defined corporate law, and they resolve disputes between investors and management readily and easily. But that circumstance is changing. So in future seasons and in other episodes, we'll talk about the future of corporate law. But for now, we're going to focus on our matrix. And so with that, thanks for tuning in to Organized, the Business Law Breakdown. I'm Professor Seth C. Oranburg, and I'll see you next time when we talk about general partnerships.